Hello and welcome. The International Monetary Fund has for the first time warned that Ghana and other countries in Africa risk being vulnerable to global financial shocks due to the over-reliance of foreign investors. Now, according to the Bretton Woods institutions, foreign investors can pull out their capital at a short notice when the economic conditions become unfavorable to them. Are local businesses in the position to cushion the economy in event of a global trend of which we have little control over? Perhaps it's time once again to look within ourselves for solutions and control. Joining me in the studio to discuss this is Paul Frimpong, who is a chartered economist, African affairs analyst, and a deputy. Oh, no, sorry, that's the continue. We'll be joining on the phone by Deputy Minister of Finance and Economic Planning, Atu Forsen, who will join us on the phone in this discussion. My name is Nana Sakwa, and this is PM Express. Well, hello, and it's a very deep discussion we're going to have today, and probably an education as well. IMF warns Ghana of financial shocks. Basically, what they're saying is that there's so much of foreign capital money in the country and sort of moving the economy along. If these guys one day decide that, well, you know, maybe Congo, it's a much better place to invest, so we are taking our capital to Congo. And then the mines and the telcos and everything pulls out. What then happens? That's how I understand it, but I'm sure we're going to get a better explanation from Paul. Paul, welcome.
Thank you. Thank you.
Paul, I hear this is the first time we have been warned, which means it's like we're hitting a crisis level, even though we're not allowed to say crisis in the country now. So maybe critical, challenged level. We're hitting a challenge level. But IMF is saying that with the amount of foreign investors in here, if they pull out, you know, it's going to be shaky. But then there's foreign investors everywhere at every given time. So what makes ours different?
Yeah, I think it's a mixed bag, actually. And what this means is that they are looking at globalization as a new trend in the world now, because all markets are integrated. It means that no country is an island. We have your domestic dealings, but you have access to external market as well. So they look at so many factors before they come out with some of this report. I think when you look at Ghana, which they included in some countries in Africa concerning this report. They look at various things, various numbers in the economy, because that's what they base on to really give us some of these critiques or some of these warnings ahead of time, so that you know what's happening out there. Because I think it's time you start to live our life as if nobody owes us a living. But if we continue to live our life as if somebody owes us a living, then it becomes a problem, because they also have their own problem to look at too. And then if you try to depend on them solely, then there's that challenge, because we saw what happened in 2007, 2008, the global financial crisis. We saw what happened in just 2012 or so, what happened in Europe. East Europe was almost down. Greece, Spain, Portugal, we saw what happened in those countries. So what you are trying to say is that now it is good. Now is the time for Africa. Really, there are so many positive numbers in favor of us. Look, there's no better time that a lot of issues economically, positive ones have been talked about Africa than now. When it started in 1970s, 1980s, trust me, the story about Africa was so bad, was so bleak. I mean, so dark. We describe as being hopeless continent, dark continent. But it's by all the same by all this, because we saw a number of people in conflict, religious clashes here and there, because we've seen what's happening in CAR now, Central African Republic, where Christians are picking arms against the Muslims. And all those issues were happening in 1970s, 1980s. It wasn't in one country, not two countries, but then a lot of countries were
36 out of the 52 countries
were in conflict at that time. Poverty was really, really huge. A lot of people, young people were dying before the age of 5, which was not good. Diseases, here and there. So those were the stories around Africa within those periods. So it was very, very horrible looking at that figures. And in the turn of the century, which is coming from 1990s to 2000, where it has moved to this time now, there's different story being told of Africa. We talk about Africa rising, the potential that we have as a continent, which is very, very good, because look at the numbers and compared to what was happening in 1970s, 1980s, it is very, very good, very, very positive. So now that's why a lot of these issues, the moment we start trying to hit at a point, they come in. Because they don't want, because when it's good for Africa, it's good for the whole world, because they know the potential that we possess. Now we have a huge population, over 1 billion people. That of what's happening in China and Europe, which has China and India, which is helping them to rise to the level that they are now. A number of factors as well. We look at our debt to GDP, which is actually dwindling compared to what's happening in those periods. Democracy is also actually increased. Now you just see about 1 or 2 conflicts in some few countries here and there. So all those numbers are there, and then they are trying to look at these numbers and then the positive ones that we've gotten over the period within the last 10 years, and then going forward, how we're able to maintain this momentum, this growth structure, so that we're able to develop internally rather than relying solely on the external market, because they also have their own issue. Because volatility is bound to happen to any economy, but how we handle those volatility is actually what the IMF is trying to point us to. Because you look at the numbers, Ghana, all the target that we're supposed to meet, I mean, it's so clear to us that we cannot meet those targets going forward. And so you look at the numbers, they put meaning on the numbers, and they come out with this critique that they are giving. And so we need to take it from that angle. Of course, we have the government, the manager of the economy on the other side, which also need to come in, because we need both the negative and then the positive going forward, because we need to see the action, of course, but then, so it's a mixed bag, as I say. They look at the numbers, where we are now, where we move from over the period, and where we are now, and going forward, how we're able to sustain what we are seeing now to the future. Because when we're able to sustain this growth, these numbers, which is very good, very, very positive across the continent, in Ghana, for instance, then going forward, we can talk about development, transformation, and then poverty will reduce in Ghana. So a lot of people will be happy living in Ghana, because they know that some of these things are happening internally, not because we are depending on the external world, which we cannot do away without, but then it has to be a leverage something. It's not should be that we are depending solely on the external market. For that, it's going to help us, because they have their own challenges to deal with.
Paul, so you're the economist and I'm the layman, right? So the growth now is good. The numbers are good. The signs are good. So we need to keep it up. However, in the same breath, there's over-reliance of foreign capital, which is telling me that it's this same foreign capital which is pushing the same growth that we are talking about. And so then the irony is, where do we stand? Because the very thing that is providing this growth is the thing that they are warning us against. These foreign, money coming in is boosting this growth. So indeed, even though there's a lot of growth, you find that there isn't a lot of work, and there's too much hardship, considering if you're going at 8%, then it means you should be able to walk from one job into the next job, But then it's not happening.
Let me make this sharp comment here. I talk about economic growth, which is what we are seeing now. It's 6%, 5%, 7%, 8%. Ghana, we anticipate to go around 7%, 8%, which is not feasible. Looking at the numbers, which are all going against inflation, hitting around 13% or so. Budget deficit will not be met, and then so the growth of around 7%, 6% that we are anticipating to get in the 2014, 2015 is not going to come, but going around 5%, which is good because it's above our population growth. So that is good. But when we're able to sustain, the sustainability of this growth is the issue here. I talk about sustainability and the inclusiveness of the growth. Those are two issues. So the growth is good for 5%, which doesn't make sense now because just a number of GDP growth and so on. So it's meaningless as it stands now. So the sustainability of it will make it meaningful, and then the inclusiveness of it will make it reflect in the lives of the common man on the street. So the sustainability of the growth, and then the inclusiveness of the growth, because the growth is sustained for a very long period, but then suspended at a very tiny part of the economy. Few people are involved in the production and the distribution of this growth. Then we cannot talk about transformation. Then we will come back again. Then all these challenges, so the numbers will be good, all right, but trust me, people will not feel the numbers in their pocket, and that's what we're not going to see. As it stands now, it's gradually we are getting to that point. We can sustain this growth, but if we don't make the effort to be inclusive enough, and we will not get to where we go. And talking about the numbers, the money that's coming from the external market, which is helping us to get to the level we are now. Trust me, there are equally private investment going on in the country where domestic investors are also doing well. But I'm not sure this is actually something of anti-FDI something. I think foreign direct investment is very, very critical in terms of going forward, because it's one of the means among several factors that we can use, several tools that we can use to develop our economy. Foreign direct investment is very, very key. And when I read the World Investment Report, I mean, looking at foreign direct investment to this sub-region compared to America, the Europe, and the rest, you see that for the past 3 years, foreign direct investment to this part of the world is increasing, whilst that of the West is reducing, East Europe is reducing. But then just the volume, the amount of money involved, DS is, 20 times, 30 times like ours. Maybe if America is receiving $250 billion a year, Ghana receive around $3 billion a year. But it has been, Ghana's own has been increasing for the past 3 years. So if in 2011 we had 1.5 billion, 2012 we had 2 billion, 2013 we had 3 billion.
Percentage-wise,
the percentage-wise is going up, but then the real terms, is coming down. So that's where we are looking at. So the foreign direct investment is good, which is something that we need to really leverage on to move forward. And looking at the foreign direct investment to where the IMF is saying that if you don't take care, some of these external markets, they will just come, they can pull out at any time, which is very, it's possible they can do that. And that's something that we need to look at. And then when I started by talking about the numbers which are in favor of us, so this money, they are coming to this part of the world because they think they have the market here. Look, there's no part of the world that the returns you make on Africa, you're going to make that same returns on those markets. When you go to Europe, you invest there, you're going to make like 2%, 3%. These economies are choked. But this part of the world is so, the potential is very, very good. You invest there, you make 10%, 12% on the amount of money you make. So now, in order to safeguard ourselves from this situation where these foreign investors can come and pull out at any time, then there must be drastic policy targeting a foreign direct investment. Okay, this is what we call the spider web economics. Now, it's linked with economic leverage. I know that no matter what policy I put forward, you will still be willing to invest in my economy. Okay, so I make sure that this money you're going to invest, there's a policy directing where first the money is supposed to go, because I'm giving priorities to my sectors, my economy. This is the sector I want to grow for the next 5 years, for the next 10 years, where I think a lot of my people will be involved in the production and distribution also. Because when you talk about inclusive growth, where people can move from poverty, it might be the production process and the distribution. So if a lot of people are involved in these two areas, then trust me, poverty will reduce, and then these things will reflect in it. So there must be policy direction concerning the foreign direct investment that we are receiving. It's not as if we are opening up our market so they can just pour in their money and then pull out easily. You can't do that. So that's what we call spider web economics.
But that's what we're doing now.
That's what we're doing now. So there's no direct policy targeting this sector, that this is where we want your money to come in. When it comes to the agriculture sector, for instance, maybe we want you to go to the cotton sector, we want you to invest in the cocoa sector, add value before you take it out. Then we can. So spider web economics means that my market is open for all right to you, but when you come, I'll make sure that a lot of this money will stay in my economy for the next 20 years, 30 years. You invest before you can take out your money. That we are not seeing now. That's why IMF will come out and say that if they know that it's rare policy targeting how we raise our money from the external market, how these people come to invest in the economy, and how we direct their investment, some of these critics will not come. But since we just open up and these monies are coming and can go out at any time, a lot of people, they come in and evade tax with their people, and they evade tax. They don't pay tax here and there. So that's it. So foreign direct investment is good, but then it shouldn't be crony capitalism where the monies are coming very huge, but you see a lot of few hands are involved, no transparency around it. They come and invest, they pull out at any time. That's the shocks that the IMF is actually prompting us to. So until we're able to take some drastic decision concerning our foreign direct investment in this economy, trust me, we'll be facing these challenges going forward.
Paul, is it fair to ask, assuming these foreign direct investment wasn't there, how much does the local businesses contribute to this 5-6% growth? How much is it? The local businesses.
Yeah, since the numbers are, even though the numbers are not clear, but when you look at Africa as a whole, over $560 billion were spent in a year. It's spent in a year in terms of our finance, and then out of the $560 billion, around 50 to 60 billion are coming from the outside world. So you can do that. Break down the numbers and see how much money is coming from internally. So that's why I first started by saying that a lot of this money is also coming from our own market here. But then, some few countries that they depend solely, most of the time on external market. And foreign direct investment might be changing from
500 billion and only 50 billion came. They're not that.
It's not that much. It's not significant. And then look at this. This IMF can be linked to the aid money, aid support as well, because you're not only looking at external sources. Why we are relying on the external sources as a means of developing our economy. Because you see, some countries in Africa, their budget is supported by about 50 to 60% of aid money, which is not good. And this aid started some years ago. You know, they applied it in Europe. It worked for them. It worked for them because they were not supported hugely by this aid money. 2%, 3% of their budget were supported by the aid money. But when it came to Africa, where they think they have the vision, they have the money, they have the universal doctrine, they're actually saying that economic law is like the law of engineering. What works elsewhere will work everywhere, which is not true. It is a lie. So most countries in Africa jump onto it. Here last, we have a tool which is going to help you live from poverty. So jump onto it. So a lot of these countries are now depending. Look, in 2012, the budget deficit that we hit, which was very, the record of it all, was because we were not able to get about 25% or so of the monies that were pledged to us by our development partners, which is aid money, you know, donor partners or development partners.
So
because of that, because they were in crisis. We saw what happened in America, we saw what happened in Europe. So because these people were not able to support us, we just that 25%, we dashing the 25% over there. So our budget, we fell short of our money that we're supposed to get on the budget to finance some of the things. So we run. You see the challenge over there. So this is one aspect of it that IMF is pumping us to. So it depends only on aid money. It depends only on foreign direct investment without any direction, any policy directing where you want the money to go, and then you will be facing this volatility or shocks as they say.
You see, I don't know if you've studied it, but you one then will ask, you know, within the Achampon era, which was probably 72 to 78, I think that's when we got the least foreign investment ever. And it was one of the periods where the country, you know, grew significantly. So how then were they able to do it within that area that we're not able to do it now?
You see, since the times are changing, you know, the economic fundamentals are changing. Most managers of the economies find it very, very easy to really look at something very easy. You know, you take the easiest position to really get money to do whatever they want to do in the short term, while the long term is very, very bleak. That's what we are seeing now. Because if I'm a finance minister, I know that now, because of the growth I've been maintaining, I know that I can just go out there and get some money to come and support my system here. So why should I even worry to take some of the decisions that was taken? Maybe let me say, we are saying that we're going to develop agriculture. Now we don't want anybody to come and invest in agriculture, or even if you want to invest, this is that we want you to do. Okay, which I think that maybe might push some of these investors away because they think, I mean, you are not the only market that we want to invest in.
If I come, it will take me 10 years instead of 3 years, so I'm not coming.
Yeah, you understand. Which I don't think should be our worry, because as I started by saying, everything is in favor of us now. So we need the economic leverage now. Okay, so those decisions were taken because those are tough, drastic decisions that need to be taken now, but we are not seeing them because it's very, very easy. When you go out there, you talk to people, they know that, I mean, this part of the world, it is very good, I can come and invest in. And these are short-term means of financing your internal system, which is not good, which is not helping us. So we cannot see those, we are not seeing those things, what happened in 1970, 1980, because then, if you don't do it, nobody is going to come and help you. You understand? So 1970, a Achampon era, if you do not develop your market or you do not try to provide your means of sustenance, nobody is going to come and help you because everything is against you. There are so many wars around you. Your neighbor is fighting, killing themselves. So there's no way I'm coming to invest in your economy. So then time you need to take this decision. We are not able to take some of these bold decisions now because we think we are moving forward. So I mean, it's very easy. If I need money, I can just go to these people and then we can get money. As the finance minister is saying, that it's possible that we might fall on the IMF, which, I mean, it's neither here nor there. I mean, it's not going to help us going forward.
The repatriation, you know, you were talking about people going to invest in America, even though it's big, the percentage-wise. I mean, obviously, they will come here because, you know, they'll sign papers that will say, look, whatever money you bring, take it. Whatever profit you bring, take it. Plus, you have a 5-year tax break. You know, everything, including the kitchen sink, you can have it. Now, how much is those deals costing us?
Yeah. You mean
this sort of deal where, you know, you have a 5-year tax break, you can take your capital back, you can take your profit back, you know.
Yeah, I think it's one of the means of trying to attract foreign direct investment.
And we attract it, but it must cost us.
Yeah, it costs us. But that is something in the short term. You're looking at the long term, what's going to help, how it's going to benefit the economy. Because I know that in northern part of the country, they're giving a 5-year tax break if you want to invest in agriculture over there and add value to whatever you put 5 years. It's one of the means of trying to look at the long term. So those are some of the bold decisions we need to take now. It's good. I mean, you know, we are going to lose a lot of money.
They all fold up in 4.5 years' time. A great majority of them will fold up in 4.5 years.
That's why we need to be strict on our measures. Okay, we didn't just put them on paper. You sign onto it, you know that in the next 5 years. Because we saw a lot of companies, by the time they know they're going to the time they're supposed to pay tax, they will change the name, or they sell to another company, they will come in a different name, different form. So we give that person another 5 years tax break, and then while it's getting to the time, the person will also change the name. There was supposed to measures around it to make sure that we really follow to the rules on the paper. I mean, with that, there's no need to worry about some of these breaks that we are giving. It is a means of attracting investment for the long term, for the medium term to the long term, which we think is going to help us. So we do that.
But see, Paul, then you see the other side is that it becomes so unfair for you, the local guy, who also wants to go into the same business, because you might not get, that even playing field.
Yeah. So I think, first of all, we need to look at certain things before we take some of these decisions. What are the areas that we think we need foreign hands? We need external money to help us develop those areas, because some of them are very, very capital intensive. Whether it is financed by government, financed by private sector, or combination of both. I mean, joint venture. Then, so if we think that we know that this sector is solely reserved for local investors, that's why we talk about local content, whatever. I mean, in terms of our investment structure. So if you want to come and invest in any sector, you need to have a local partner, which I know they are using the back door. You just come and see one person, blah, blah, blah. I need to set up this company. I need to partner me as if I'm just partnering with you. Which they know they are not doing that. They're just giving some money to forefront it for them. So we look at the sector that we think it is meant for local producers or local manufacturers or local investors. And look at a sector that we think this one is open to the outside world as well, so they can come and invest in. So if you have that demarcation, you know that this is meant for domestic investment or domestic investor, and this one is also meant for both domestic and outside investors. I think we can take it from there. So it shouldn't be a worry that we think these multinational companies or investors are coming to come and invest in sectors that is supposed to be open to local investors as well. We can have that room to attract such investment from outside world, but then it must be that direction that maybe Ghanaians are supposed to invest in this sector. This sector is only meant for Ghanaians, and then this sector is like the Tesla industry, for instance. Look at what is happening to our local investors, which is not good. So with that sector, for instance, with that side of the sector, you think that no, this is meant for local investors. So no foreign investor is allowed to really touch on the Tesla sector. Mm-hmm. But we take agriculture, which I think most Ghanaian investors will not maybe want to venture into. So you think you can open that agriculture sector to outside investors, which we think in the long term, the medium term, the long term is going to benefit the whole public. So I think we take such.
How then do we encourage local business to risk the minings and the ones which they demand a huge capital, probably longer term, but the returns are good? You find that we are more into, let me import my rice and sell it. Let me import my sugar and sell it. And even the banks themselves are more willing to give you money, on the short term one rather than
long term. Yeah, I think trade finance or capital finance, I mean, in terms of our investment, is very, very not helping our local investors also, because there's no money in our banks. They are not strong enough to finance some of these big projects. Like I was in an investment forum with some group of investors from Europe, from America, from Latin America. They were all around. They are in Ghana. They are looking around Africa, trying to find opportunity where they can invest. And trust me, I saw most of our big managers over there. They also come to ask for money from these people to inject into their bank so that they can be able to finance some of these big projects that we are seeing now. Very, very capital intensive, I must say. Mm-hmm. But trying to, I did not always dwell on how we can, though I know we need to promote our local investment. We need to have a lot more local hands in the investment sector. But look at our growth, and we are saying that it is being driven by this same huge capital intensive sectors like the mining, like the oil. These are the sectors that is actually pushing us forward, because we saw the numbers, the 2011 double digits because of the oil, and now it is coming down because we see that a lot of this money are going out. None of them are staying, and they can take decision at any time. You saw what Newmont did recently. They can take decision anytime. I'm laying off 500 workers. These are all coming back to government, because you need to provide work for these people. Look, when one Newmont worker is laid off, it's not only one person, like a whole town being laid off. Because you know how much they pay you, and you can know the number of people that each individual support in the family line. So one person is gone and the whole family is uprooted. So you get 5 people, you have a whole town in Ghana going to sleep without food. So we need to look at around those areas. So it's not really about, because the banks do not have the money, they are not strong enough to finance some of the. That's why the capitalization was good too. You need to be able to raise their capital base so that we're able to finance long-term projects or capital-intensive projects. If they're not able to do that, trust me, this local investor will find difficult accessing money to be able to finance, to be able to involve in this huge capital-intensive project. So, yeah.
So let me do the other thing is building local capacity.
Yeah.
And sometimes we hear capacity building. But again, we are not very fond of building local capacity. So let's say there's Accra to Kumasi. Now, instead of Ghana saying that, listen, okay, fine, Paul contractor, you can't do it alone. So team up with Nana contractor and team up with famous contractor. I need the three of you together to do the road. They say, well, let me just give it to some Israeli because he's got the 10 tipper trucks. But you could have gotten 10 or 3 Ghanaian contractors who have come up with 15 tipper trucks, which is the requirement to do the road. When I come back, we'll see that is it possible that we join companies to do a project? Because all too often you find that it's just one company that's just doing it. And then if they are not big enough, then forget it. We'll give it to the foreign one. Stay tuned. We're coming back. In there, let me just remind our businesses and individuals that as Easter is coming, reach out to people who are not so privileged in society. It's always good to give up. It's always good to help. I mean, there's somebody who's been sleeping rough for the whole year, and just that one day in a year, just that Easter Sunday, whatever it is that you can help with, a bag of rice, oil, frozen meat, tomatoes, cash, whatever, or maybe even as a body you could come over to help cook the food and give it out to people or brothers and sisters who are less privileged. It will be very, very grateful. So definitely get in touch with Joy FM, and whatever it is that you can help with, we will be very grateful and thanking you in advance. But just before we wanted to break, I just wanted to find out, in terms of building local capacity, we seem to find out that all the big roads and stuff, are built by foreign companies. And I'm asking, can we team up local companies to do it? If we are able to source the money. Some monies come with their contractors following it. But if we are able to source our money, and then some of them are even, government of Ghana money, and then you find out there's a foreign company, doing the road in Ghana, getting paid by Ghana. I mean, that's, I don't know, maybe that's a different economics. But can you team up, 3 big boys and say, look, come together and go and do the road?
Yeah, I think it's possible. It's possible. But you need to look at the issues around some of these companies coming together before they come out to really tender in to win some of these contracts to be able to put it forward. It must be a conscious effort by government or managers for the economy that is what we are going to do in the next few years, that we think we should promote local investment. Private sector development is actually key in terms of, this part of the road that we are growing up. That's why we tend to focus more on the external market, because we are not able to generate money internally. Before we're not able to develop our private sector to a level that we can leverage on them to get the money that we need. That's why we always fall on the external market for money. So if it's an agenda that we want to push, it's possible. We can do that, because some of these are very, very capital intensive, as you said. Some of these, though they are government money, but we think some people, this is what we call chronic capitalism. Because they know it's capital intensive, we need money, we need to invest in the long term to do this, but then they do it among themselves. They tend to favor a lot of people.
If we take this, the Gang of 4 road, they were all financed by, Bank of Ghana money. But the roads have been built by Chinese people. I mean, what I'm saying is, could you have teamed up some local guys to do it? Build them, because then they get more money and then grow in the industry.
But I'm sure that will come from the private individuals themselves, the investors themselves. That will not be from government, because government cannot say we are going to team up 1 or 4 these companies together for them to come and construct this road. It has to come from the individuals. If only they are willing to team up together and then move forward as a team to get those contracts, that will be feasible. But then government, the policy might be there that we want to encourage local investors. So if you think you have the money, you have the capacity, you can tender and compete. If you come in, we give you the liberty to do that. So that could also be a policy direction. Let's say we're not going to allow maybe any foreign investor to actually venture into this area, because we think this area is reserved for local investors. That's exactly the point I was trying to make. Okay. We're able to do that and empower local investors, so we're able to leverage on them here, raise our own money internally, than to focus on the external market. then we will come back to this same issue again.
I mean, my argument is, well, if the money, let's say, came from UK, and there's a clause to say that we need a UK consultant and a UK contractor, okay, fine. But if we have taxed ourselves and come up with our money too, why are we going to bring a UK contractor?
Yeah, the avenue must be there for local investors to take such initiative than to really always look at the external investors to come and do some of the things for us.
Now, Paul, once you need to educate us on this, because we've heard this thing so many times. Now, read it. It says, Ghana's first 10-year Eurobond, which was issued in 2007, was 4 times oversubscribed, but yielded as little as 4.5% in April 2013. What exactly is contained in the Eurobond? Big question mark. And in August 2013, Ghana sold a bond of 1 billion with a 10-year maturity potential at a yield of 8%. The yield was higher, and in excess bid were lower. The yield was higher, and the excess bid were lower than those in other African countries that issued Eurobonds earlier in the year, perhaps partly reflecting the deteriorating financial conditions. What is the comparative advantage, if any, and who really benefits? First of all, what's this Eurobond business before we even go into why, we're accepting 8% for it?
Yeah, I think this is going to be a capital market, external capital market. We have the domestic capital market, which is what we see, the T-bill, the treasury bond, blah blah blah, in the stock market, which is one of the means of the capital means of raising money. And then we have the capital market with the external market. So when you issue, the Eurobond is actually a certificate. What it means is that you go out there, people will give their money, and then you agree to pay them the next 10 years, depending on the maturity date, 7 years. So 7 years time, the bond will mature, so we pay them. But then they give you the money, they discount it according to the percentage that you are giving them. So if you're giving them 7%, I'm supposed to give you, you're supposed to give me 1,000 Ghana cedis in the next 10 years. So let's say the certificate on the face of the certificate is 1,000 Ghana cedis at 5%. It means that we need to discount the 5% to the next 10 years, and I will give you that amount of money. But the maturity, you're going to give me 1,000 on the face of the certificate. So but we are not going to give you 1,000 cedis now. I'm not going to give you 1,000 cedis, but you give me 1,000 cedis. So I'm going to discount the 5% on the 1,000 for the next 10 years, and I will pay you the amount that I'm supposed to give you. But when it gets to the maturity date of 10 years or 7 years, you give me 1,000 cedis. And it's actually issued in foreign currency. I mean, normally in the dollar.
So you pay the 5% per annum.
Per annum
and
discount,
then come to the end of it.
Yeah, and then that's the amount of money that the government will get from those. But then the maturity, the distance on the face of the bond and the certificate is what the government is going to pay to these people. It's a means of raising money from the market. But then when the cost of borrowing this amount of money is very, very high, then you have a challenge. I think the 2013 example that they gave, I think around that period, some countries in Africa, I think Nigeria also, and then I think Uganda or one of them, Rwanda also, they also issued the same bond. But the rate that they had, the coupon rate, the interest is supposed to pay, the coupon rate is the amount of money, the cost of the borrowing, So you get 1,000 cedis, you're supposed to pay 5% on it. Another person will issue the same 1,000 Ghana cedis, and then the person is going to pay 3% on it. It means that your cost of borrowing is higher than that person's own. So that's actually a challenge. It means that at the end of the maturity, a lot of money will move from your system to go and service those debts outside. You understand? So it means that you have a challenge. You'll be constricted in that sense. So that's why about the Eurobond.
I was particularly shocked when they got 8%, and you heard a couple of people sort of almost bragging that they got 8%. But at $1 billion, 8% is really, really high. If you look at interest rates in the advanced world today, 2%, 0.5%, 1%. So why would we accept 8%? I mean, I'm sure we have, we have stability, we have peace, we have investment. I mean, you must add to the negotiation.
I think you have. First of all, the negotiation will go forward. I think that's what the finance minister is saying. They put together a negotiation team to go out there, and I think they've accepted already that they're going to issue the bond this month. I mean, later this month or so. He said it's possible it's going to go this month, because earlier on the report that they're going to suspend because they think the macroeconomic stability is not good for us to go to the market. If you go there, you're going to pay huge interest on the amount of money you're going to borrow. So he thought that maybe you're going to suspend for the short term, and then maybe going forward we can structure to make sure you have a good macroeconomic outlook before we go out there. So it's all about negotiation though. But the numbers too are there. You're not only having the numbers. It's not only you who's having the numbers. that mess around the world. Everybody knows what's happening in Ghana. So if you come there and you think, we have this, we have that, but they will tell you, no, we are seeing this instead of what you are saying. So because of that, trust me, the rate of your default is very, very high. So you need to pay us this interest before we are going to invest in. And that's why we always have that challenge where we need to pay more than what we think we are supposed to get at the end of the day. Yeah.
I was going to move to Finch ratings, but before I do that, I mean, what does the state do to raise revenue or generate some money? What does the state do? I mean,
yeah, I think first of all we look at internal market first before we can talk about the external market, and that's basically most of the things revolves around revenue. Okay, tax. I mean, tax revenue is supposed to be the key. That's always been the key going forward. And then how your capacity to be able to raise enough tax revenue depends on how your economy is structured. Okay, if you're not able to develop your private sector to a level that you think you can leverage on them, trust me, there's no way you'll be able to raise enough tax revenue. So always you have to look elsewhere for money, which is not healthy, which is not sustainable. Because you do that, as we said, you are subjected to these external shocks. Any day, anytime, the economy can collapse because they also have their own issues to deal with. So if you're able to develop your private sector to the level that you think can leverage on them, then we can talk about, you being able to raise enough tax revenue, because that's going to form a huge part of your revenue as an economy. And looking at the private sector development, for instance, there are so many bureaucracies in our system trying to develop a private sector. Look at the SME sector, for instance. I mean, how long would it take for somebody to register a business in Ghana? What are the issues around business registration in Ghana? I mean, those are all issues around private sector development. And then look at foreign direct investment, which is also another means of raising money. Look at your manufacturing sector, how you to add value so that you earn more foreign exchange on whatever you put out there. Because if you're exporting only raw material, they don't have a value, they don't have determining power in terms of determining the market price out there. You go there, whatever they give you is what you take, which is actually what's causing some of the deficit we are seeing. We fell short around $1.3 billion or so on the cocoa price, because the cocoa price on the world market is actually dwindling. Why? Ghana is the second largest producer of cocoa in Africa, in the world, I don't know, but second largest producer of cocoa. Yet we go out there, we cannot determine the cocoa price on the market because you're just exporting the raw material. We are the people who add value to whatever you bring. So we are going to tell you, I'm going to buy this at this price. If you don't want to sell, you can take it to wherever you want to go, because we know when you take it back, there's no any country around you which is going to accept whatever you have, because they are also producing the same thing. Look at gold prices on the world market, is also falling. So the manufacturing base is also very, very key. Instead of more manufacturers, we can earn more foreign exchange, and that is also another means of raising money. And then being able to trade among ourselves as well, as people, as African, as a continent. Trade is being restricted very, very, very on this end, because look at trade between African countries, around 10 to 12%. When you go to Europe, it's around 60-70%. Wow. And go to Latin America, it's around 25%. When you go to Asia, it's over 50%. America is over 50% as well. But when it comes to Africa, it's just 10-12%. These are tiny 54 individual countries scattered around trying to do something on their own. This is not helping us, because we're not able to trade among ourselves too. We tend to lose a lot of money in that sense, and there are so many bottlenecks in terms of being able to trade among ourselves. So that's also another means of trying to raise money to be able to finance our development. Yeah.
I'll take a break, and then when I come back, we'll look at Finch report, downgrading us from B+ to B. What does it really mean? Do we care? Should we care? Stay tuned. Well, hello and welcome. And before, again, I'm reminding you that Easter Sunday, Easter Soup Kitchen, just reaching out to people who are not as privileged as us, people who are sleeping rough, people who are destitute. So anything at all that you can help with, rice, oils, tomatoes, things that can cook, maybe clothing which you don't even use anymore, contact Joy FM, give it kindly, and it will definitely serve a good purpose. But I read some of your comments. Bernard Ozal says, blame the government. We are over-relying on foreign investors too much. Jacob Aziz says, today I'm celebrating my birthday, so no comment. So happy birthday to you, Jacob. And William says, Ghana to our ESO. And then I have here, was an interesting one that I saw. I'll find it for you. Yes. James Barima says, Nana, but the president self say we have to borrow more money. am I his co-equal to say no? To say no, let us borrow. Muhammad Day, why?
Very interesting.
James, good evening. And then I have this one from Sam Mekuban, who says spiderweb investment theory. Now, do the economic advisors to the president know this? Does the trade minister, his directors, and guys at GIPC know this intelligent strategy? We have encouraged and tolerated too much of positional leaders rather than performance-oriented leadership. This is what is killing us. Go to school, get a certificate, get a position, and grab the benefit with the position instead of going to school to get educated and get a position to perform and get the benefits. We forget about the performance and just focus on the benefit grabbing. But Paul, we've been downgraded from B+ to B. Before you even answer this, and I don't want to use crisis, because Barima says crisis, and then the whole, but they prefer challenge.
Challenges.
Yeah. So how challenged is the economy? Medium challenge, low challenge, or high challenged?
We are challenged. On all fronts. There are so many issues around.
So medium challenge.
Yeah, I should say. Yeah.
You say medium challenge. But okay. So then my next question is: we are now medium challenged. Are there anything in place? Do we see factories coming up? Do we see educational policies coming up to move us from medium to low challenge?
Yeah, I'm not seeing those things that you mentioned, but what I'm saying is policies around infrastructure development. That's what I'm saying, because if you should go by what is stated in the budget, which you are going to miss on so many targets, and what the finance minister gave yesterday, actually talking about the Ghana Infrastructure Fund, which is going to be the target. It's going to be the main reason why this new Euro bond is to be issued, where we could be able to get money in there to finance most of our infrastructure. So I think infrastructure development will attract more investment, both locally and externally, to be able to move our economy forward. So actually that's the only area that I'm seeing. I'm not seeing areas policies on the oil sector where we think we can be able to drive the investment there, the returns there to be able to.
Will infrastructure alone work if production and industry?
Yeah, that's what I'm saying. I'm not seeing a lot of policy direction in industrialization, which we think is very, very good. Because look at the agriculture sector, for instance. We are investing in agriculture. We are taking agriculture sector as if just like a foreign exchange earner, instead of trying to look at it as a means of going to feed ourselves and at the end of the day becoming a net exporter of food. Right now, after being endowed with over 60% of the world's arable land, I'm talking about the whole continent, we are still a net importer of food. How many bags of rice do we import into this country in a month? Not even a quarter, in a month. Very, very huge. It is not something that you cannot really accept anywhere because of the potential that we have to be able to produce more quantity of rice, to be able to even be an exporter of rice. Yet we are net importer of rice, which is not helping us. So if agriculture sector, and we think we can, and we have to link that to industrialization, which I'm not seeing that now, because we saw the industry in the 1950s, 1960s, all have collapsed. Now we don't have any to lay our hands on. So I think I'm not seeing such policies.
Then that's where. So then my question now is: so from medium challenged, where are we heading to?
Yeah, I think we need to see more drastic measures. That's what I'm not seeing in where we are now. We need to see more drastic. Economic policy. That is what we want to do. Look, I always say that when economic policy is taken, okay, and then when you go behind it and you see that this policy was taken because it was too easy to take that decision, trust me, that very challenge that you took that decision to solve, it will come back again. And that's what you've seen over the period. It becomes so easy to take a policy. Trust me, that challenge, the reason why you took that policy, that challenge it will come back again. So unless we see those difficult, tight measures to try to say that we are moving our economy from this level to the next level, the next 5 years, nothing. Look, we cannot just jump. It's not something that the results will be seen now. Some of the measures that we have to take, it has to take some time, and then so we have to be some plan. Okay, this year we want to do this, the next year we do this. So by the time we get to the 5th year, by the time we get to the 10th year, we know that we move from this level to the next level.
Let's look at our grading from B+ to B. It's not the end of the world, or
yeah, indeed. It's not the end of the world. Fitch is a risk rating agency. They put a risk on companies.
Imagine, okay, with B+, we got 8%, right? Yeah. With B+. Yeah. So with B, what sort of percentage are you looking at?
Yeah, it means that you go up. I mean, it means that we have to pay like 9% or 8.5 or 9% on whatever money we borrow out there. It means that what they are saying is that it's more risky. I mean, the rate of default of the government of Ghana on paying your money is very high. So they have to pay more before you have to give your money to them, or you have to pay me more before I give you your money, because the possibility that you're going to default on the payment because of what I'm seeing in your economy. I mean,
but they should know that if we had gotten that 20%, 25% in aid, we wouldn't have been here. So it wasn't intentional. I mean, can't we argue that?
No, not really. I mean, you can't really depend on your life on them as if the owe you're living. No, you need to look at your own structures, make sure you're able to live on your own resources. Rather than we have so many natural resources. Natural resource management is very, very poor in this part of our world, and these are things that you cannot really blame anybody for saying that you're mismanaging your natural resources. Because of that, I think when you come to borrow money from, you're going to mismanage to the level that you're not able to even pay me my money back. So you have to pay me high interest before I give my money to you. I mean, why should that happen? Why should somebody look at the management of our natural resources to think that because of what you are doing, I'm not going to give you this money at a very cheap rate? You have to pay me at a very... I mean, if you're able to manage your natural resources, you're able to manage your deficit, everything all right. I mean, we don't have some of these issues that we
seem to be borrowing our way out of trouble. I mean, we borrow our way out of trouble. The president seems to say, so far as we are borrowing to use it for prudent things, then, borrow away. Finance minister is also saying, no, hold on, I have to go easy on this borrowing. And as an economist, to ask, which is which? Do we borrow or do we not borrow?
Yeah. We have the borrowing threshold, which is around 60% or so of your total GDP, and you're around 50-something% or so, getting closer. But I mean, the issue has always not got to do with how much you borrow, because what you use the borrow money for. That's where we have the challenge in Ghana now. Okay, we borrow much, but we not see why would you go and borrow and then all that you use the money for is to finance short-term recurrent expenditure. I mean, that's not sustainable. It's not sustainable enough. It means that in the long term you have to find means of getting money to pay all those borrowed money. And that's going to be a burden on the whole economy. The whole economy can come down because of what you did. But unless we know that we are using the money borrowed to invest in that, we know that in the next 3 years, in the next 5 years, we're going to bring out this returns. So you'll be able to use that return to pay the interest or the principal and the interest in the long run. But if you're not seeing those investments and the capital expenditure side, only using to pay wages and salary, blah blah blah.
But with all these challenges, and then you work EPA on top of that.
Then we are gone. I mean, we are dead. I mean, the EPA coming on board. Trust me, that one is going to cripple us. It's sharp therapy. Trust me, it's a blitzkrieg. It's going to cripple us. Trust me, going forward in terms of industrialization. All this noise we are making, industrialize. Trust me, that one is going to kill everything on the spot.
Well, folks, as I always remind you, tomorrow is Thursday, so those of you who have access to My Joy Online or Joy FM, 205, I'll bring you the program I call That's My Opinion. And tomorrow the topic is that Ghana belongs to the unborn, the living, and the dead. And as soon as we forget that principle, we go back into slavery. It's a beautiful piece, and don't miss it. Tune in, 205. I'm saying Ghana belongs to the unborn, the living, and the dead. Don't forget that principle. And as I always say, thank you very much, and thanks for watching. Tomorrow we'll be back to do it all over again. In fact, tomorrow I have Neil and Tay Vanderpoy on here, and we're talking about EPA to say that do we sign or not to sign. It's going to be very interesting, so tune in.